Welcome to this session. This session is called Traditional Access to Cryptocurrencies via ETPs and Digital Asset Treasuries. And we are an esteemed company to discuss this topic. As Rob quite rightly said, institutions begin and continue to kind of start moving into digital assets. So we're going to be talking over the next 50 minutes. I'm going to introduce myself, then I'll let the panel introduce themselves. And we'll probably talk for about, hopefully, 40 minutes and then open up for questions. So do kind of have a think if you would like to ask everyone whilst they're here. So to start with me, my name is William Palau. I'm a chartered accountant in a room full of lawyers. I'm used to that. I've been involved actively in the crypto assets space for about 3 years, and I've been involved within Crypto Workshop for the past year, because whenever I come to these conferences, the two words that jump out of them is regulation, and we've talked very nicely and eloquently about that this morning, and we'll talk a bit more about it later, and education. And it seems apparent to me that with one foot in the traditional asset finance world and one foot in the crypto asset world, the big challenge in this space is to educate. So we provide bespoke courses for institutions and individuals and monthly boot camps. So I'll pass to my left. Joe, go for it.
Hi, I'm Joe Hall. I'm a partner at Davis Polk in New York. I've been involved with crypto ETPs since 2014 on behalf of my client Grayscale. And I've been involved with digital asset companies since 2020. I've done all the underwriter side work for MicroStrategy.
Thank you. Welcome. Josh.
Hi, I'm Josh Klayman. I'm with Linklaters, where I'm one of our global tech sector co-heads, and I lead our US fintech efforts, and I'm the head of blockchain and digital assets. My background is in traditional finance, and then for the past 10 years or so, I've been involved in digital assets.
Very good, thank you very much. Hi, I'm Peter Lane. I'm co-founder and CEO of Jacobi Asset Management. We launched Europe's first Bitcoin ETF. Well, it was approved in 2021, but then as we were about to list, FTX crashed, which caused a bit of a problem. So we launched it a couple of years ago. Previous to that, I started working in the city in wealth management the day Lehman Brothers crashed. So all very aware of bad things that go on and why sort of Bitcoin and crypto came along to try and fix those systemic problems.
Fantastic, thank you. So the way I really want to structure this is really go on and kind of talk about how we've got to where we are today, talk a little bit about where we are today, and then talk about what the future holds. And I don't think we could be in better company. And I'm kind of in huge awe of both, well, all three of them, but certainly Joe and Josh. Josh, who's kind of in and out. You know, how long are you going to be in town for? 5 hours? Yeah. So we're very, very lucky to have her. So really what I want to know, and we're going to move down the panel. Joe, you know, you mentioned you've been involved in this space, since 2014?
Yes, except I didn't start buying Bitcoin then, which is a shame.
Right, yeah, and that's actually a distinction we want to make, actually, as our conversation starts. So just tell me, you know, you mentioned Grayscale, you mentioned the experiences you've had up to now, and when they launched, when these ETFs were finally approved by the SEC back when they were, and since that time, what have we got, about 150 billion wrapped up in these now, invested?
Oh, at least.
At least. You know, take us on a bit of a journey as to what 2014 looked like and what it looks like today.
Well, Grayscale's the CEO of its parent company, Barry Silbert, who's a pretty well name in this space. I mean, his great innovation more than 10 years ago was figuring out a way to allow people to hold Bitcoin even if they didn't you know, understand how to set up a digital wallet, or even if they, you know, were a little skeptical of the online trading platforms that were available at that point. He had a role in the passage of something called the Jobs Act in the U.S. back in 2012, and one of the innovations of that act was actually to allow companies to sell on a private placement basis securities through what we call general solicitation in the United States, or just general advertising. Mm-hmm. And he put those two concepts together, and he came up with the very first Bitcoin fund. And was able to market it on a private placement, meaning not having to go through SEC registration. And he was able to build up, you know, quite a big product. He was the only Bitcoin fund in the market at the time. His goal from the very beginning was to make that function as an ETF. In other words, to be able to use the arbitrage mechanism, which will align the share price to the underlying asset value price. But the SEC just would not permit that for many years. And we actually finally had to sue the SEC to allow that to happen. By the time the SEC allowed it, there were products in Canada, there were products in Europe. The U.S. was really, unfortunately, a laggard to that market. That can all be blamed on the man who sort of ran the SEC, during the Biden administration. I think that's pretty well understood. Now we're in a completely different environment. In the new administration and with Paul Atkins at the head of the SEC. But at the same time, Barry's original innovation, which was to make it easy to hold assets, without having to hold them in digital form and instead, hold them in the form of a share. I think that idea is under a lot of pressure now with people being a lot more comfortable holding assets directly, whether on Coinbase or Gemini or another retail platform. So I think there's a question, particularly for these single asset trusts, whether that makes sense when you're paying whatever the number of basis points is for that ETF product. So I think we're coming to kind of a fork in the road for the single asset trusts, and managers, Grayscale included, are becoming more creative in terms of the types of products that they're offering right now. Sort of maybe that just shows that the industry is getting more mature.
Well, yeah, so that's one of the things we were talking about, the kind of the signs of market maturity. But Josh, anything you would like to add to that in terms of the experience and kind of in the US market, how things have matured since your time in this digital asset space?
So building on what Joe just mentioned about the crypto ETFs, there continue to be developments in the US. I share Joe's view generally about the future. However, we just saw in the past few days the SEC approved generic listing standards for spot crypto ETFs, right? And that was really one of the holdups. That was the way that the SEC was preventing and slowing down ETFs from coming to market. What Joe mentioned about the Grayscale suing the SEC and getting a federal judge to say that the SEC had acted arbitrarily and capriciously in denying the ability of the ETF to become effective. A lot of this, it ties back, let me just say this. For the process, the exchanges themselves had been seeking rule changes, right? They had to request rule changes because the spot crypto ETFs did not conform to what are called generic listing standards. So now we have them, they have been approved, and this, I think it can help move things more swiftly. But I do think that there's a big movement right now that you guys probably all are aware of towards digital asset treasuries. Yes, which we're definitely going to be talking to in a minute. So, Peter, we've heard kind of the US story. You were involved with the founding of Europe's first ETF. Give us a bit of an angle from here and from there in the UK.
Well, first, I'd like to thank Joe for suing the SEC. For those who aren't really particular Bitcoiners in the room, Bitcoin would be in a very, very different place right now if he hadn't successfully done that and Grayscale hadn't forced the SEC to allow the Bitcoin ETFs. You wouldn't have had BlackRock launching the biggest, most successful ETF in history. You wouldn't have the regulatory adoption that we've had in other countries around the world. So that was unbelievable. There's not many things you could point to say that changed Bitcoin, but that changed Bitcoin forever. The European market's a bit different to the American one. We've had crypto exchange traded notes in the European market for quite a few years. We managed to launch the first crypto ETF, Bitcoin ETF, because we worked out sort of a regulatory arbitrage of how you do it. So we went to speak to the Guernsey regulator, who aren't governed by EU regulations. They're not really, they're an autonomous regulator. They have to do things as progressive to make themselves available as an international hub for things. Yeah. So we went and spoke to them. They seemed open to the idea. They was very cautious at the beginning, like most regulators. But then the next challenge was, well, how do you make that a relevant product within the European market? Because if you listed it in Guernsey, it's not really all due respect to Guernsey, it's not really that relevant a listing. So we were then looking for a regulatory pathway to try and find a major listing venue. So we ended up going down the EU designated state regime, which allows an EU member state to nominate a non-EU member state to, say, like an equivalence regulator. So fortunately for us, the Dutch regulator sees Jersey, Guernsey, Hong Kong, and USA as equivalences. So they allowed us the first single asset Bitcoin fund to list inside the EU. And so that's how we've got the only Bitcoin ETF in Europe, because we kind of went down the hard route to try and create a different product. We're finding all sorts of issues with that as a sort of a knock-on effect, because the UK don't really subscribe to that. Now they're not within the EU. So the recent changes in the UK market for allowing crypto ETNs to be listed in a week and a half or so, that is specifically for ETNs because we sit inside a different regulatory framework.
Yeah.
So there's rules upon rules upon rules, which the FCA don't really seem worried about changing or trying to work within the existing system. And I do have a bit of sympathy for them, because there's, as I said, there's rules upon rules upon rules that were written before Bitcoin existed. So it's not easy to just slot it in there. So what the FCA seem to be doing is the only quick and easy way to look like they're Bitcoin or crypto friendly. But funny enough, there's other regulatory regimes that would allow. So you could have a Hong Kong single asset fund list in the UK to retail, but we can't have a Guernsey single asset fund list in the UK to retail. But our Guernsey single asset fund can list inside the EU to retail. So that makes sense.
So you can, there's a way.
Well, there's a way if they wanted to do it. If they wanted to be Bitcoin friendly and they wanted to push this exciting industry we're part of, they could do it, but they're not.
And that actually, talking about this Bitcoin, and maybe it brings it onto these treasury companies, by achieving that vehicle, kind of product, a vehicle that you did, how much pent-up demand did you feel? So it indicates, when these BlackRock brought out their ETFs, it's the most successful one in history. How much did that open the gates in terms of being able to access the kind of institutional investment?
At the time we did it, there was none, to be honest, because
Right.
European institutional investors are generally a million miles behind American or Asian, etc. So when we listed, we were only open to institutional professional investors who at the time weren't buying Bitcoin. They were all wrapped up in ESG funds.
Yeah.
Then I won an argument with the Guernsey regulator to be able to list to retail investors earlier this year. And since then, retail investors in Europe are much more aware, but they've had crypto exchange-traded notes for years. And I think going back to your point, I think education is the key, because I don't see in the European market massive demand like there is when the Americans listed, because the American market seems much more focused on building new industries.
Yeah.
Europeans, they just look to try and hold things back because they want to work on the best regulations while the rest of the world just gets on with stuff. So the demand, in my opinion, isn't that great in Europe.
Yeah.
Compared to other areas of the world,
Interesting.
and I think it's held back by regulation and education.
Those two buzzwords.
Yeah. Yeah.
So let's go for it. Let's get into these treasury companies. Josh, maybe just for the benefit of the audience, can you just give a kind of summary of what they are, how they work? And of course, we've got Joe, who's been involved with MicroStrategy, so you can add to this show. But maybe just to start, how they come about and what demand they've met in the market.
So, how they came about, MicroStrategy, now Strategy, is like the godfather of them all,
Yeah.
right? I think people have looked at the success of that, and they have seen some of the challenges with ETFs. For example, the slow timing to approval, the inability, although we think it will change with this current administration, of ETFs to have staking, right, for proof of stake assets, and also because some people can't, or some entities can't invest in ETFs, right? So basically, they're public companies. Often this is achieved via a SPAC, and may have a PIPE structure, right? But basically, people are raising public funds and then buying an asset. And right now, we're seeing a lot of single assets, so there's a lot of ETH, for example. There are challenges, though, because people need to figure out how to differentiate between and among the different digital asset treasury companies. Because if everyone's just saying, okay, we're going to invest in ETH, for example, how do you show a difference? I think right now we've seen a lot of fundraising premiums, and I think ultimately that's going to go away, in my view. what I do think is that what I've been hearing a lot is this idea that rather than relying upon the movement just of a single digital asset, that having some kind of opco in there, right?
Yeah.
Having something that generates, that attracts customers, consumers, that builds, so that if you have the market going down, you'll have
Something to prop it up.
Exactly.
Like a hedge.
Yeah, and I think one thing that's important and just to remember is some of these shells that are being used, they might be kind of dirty, right? So there's a lot of diligence that has to be done. There's a shortage of appropriate CEOs. I've sat at dinners where people have been saying, oh, I'm getting a call from this one, everyone's contacting me, and there's a reputational risk there. I think there's a lot of promise, though, too. I just think we need to be careful about pinning it all on one asset, because even if we think of MicroStrategy, right, there are so many shorts against that stock, right? And luckily, it's done well, right? But if it gets into the shorts, then it's going to go quickly, and others as the market moves. And we know the market's cyclical. So that's my thoughts.
I hate to cut in and disagree with you there.
Go on.
You shouldn't mix any other cryptocurrency with Bitcoin. Bitcoin is, for me, if you compare tech stocks and gold in the 90s, you wouldn't be able to say which tech stocks today would be the greatest, because the innovation's amazing. But you'd know gold's a store of value, right? So that's the differentiation you need to make. If you start investing a digital asset treasury company in other assets, no Bitcoiners would buy it because they wouldn't touch the other assets. They wouldn't want to. The second thing about having in this country, there's a few that have launched, and the side business is effectively a workaround the FCA. Nobody really cares about the side business. It's a way to get a listing. And I think if you look at all of the big treasury companies in the world, nobody really cares about the side business. That's just a way of getting the regulatory approvals to do what you need to do. The only way that will carry on and become prominent is if it is a very profitable business and they use the profit to buy Bitcoin. Because at the moment, what they're doing, they're issuing new equity to buy Bitcoin by accretively diluting their shareholders. But if you can create more Bitcoin per share by creating profit from your existing operating business and buying Bitcoin with that, that increases the Bitcoin per share without diluting anybody. So that's nobody seems to be really focusing on that at the minute. And I think that will start to become a prominent feature when they say, they'll see loads of Bitcoin treasury companies try and launch and absolutely flop because nobody cares about them. The way to do it, like if you see Smarter Web Company in this country, they were the first ones to do it. If you start small and build a relentlessly loyal group of fans that you made millionaires out of, that's how you succeed. So if you look at how many people did Grayscale make a millionaire? How many people did MicroStrategy make a millionaire? Those people will carry on buying that stock forever because they become sort of indoctrinated that they're fans. It's like, I liken it to football fans in this country. There's no need for you to support any particular football club, but some people go mental for it. And they stay with that forever, even if it could bring, like my friend, he's a Spurs season ticket holder, and he's never happy. But he buys a new season ticket every single year. That's the sort of tribal loyalty these companies need to build if they're going to get people to carry on buying through the most volatile of times. So if you start mixing in other cryptocurrencies within that, I'd short that straight away.
I would agree with that completely. I think you do have to distinguish Bitcoin and maybe one of the other two layer ones, maybe ETH and Sol from everything else. And I've been a lawyer for probably longer than a lot of people in here have been alive, and I've been through a number of different crashes, and I see crash all over the place when I'm hearing about these treasury companies based on what we sort of call shit coins in the United States, and there's just. There's going to be a terrible crash. People are going to lose a lot of money. I don't necessarily think that's going to be the case with the Bitcoin treasury companies. I do think that there is. I think, as much as we can tell after 15 years, I think it probably is digital gold at this point. But I'm seeing absolutely crazy things the other day. The other day, somebody was telling me or asking my advice on tokenizing the shares of a Bitcoin or of a treasury company. I thought, but we've really gone through the looking glass now that we're now talking about tokenizing the shares of a treasury company. And there's just the amount of froth that's out there right now. Something bad's going to happen. I don't know whether it's going to happen in 3 months or 9 months or a year, but hopefully it won't be sort of an FTX level debacle, but we've gotten a little crazy, I think.
Yeah. What I think they'll need to start thinking about doing is if their MNAV, which is their value, their market cap versus the amount of Bitcoin they've got, some of them are so tribal and they won't sell their Bitcoin at any sort of thing. But if they were smart, if they go below a 1 MNAV, they should sell the Bitcoin and buy back their shares, because they're effectively then creating more Bitcoin per share, but they're bringing the shares in. If their MNAV goes up, they should then sell equity to then buy more Bitcoin, because they capture the arbitrage. And so that's the thing that they need to really focus on. And I think one of the concerns I've got is any sort of charlatan trying to jump on this bandwagon thinking they can make a quick buck will try and do it. And what will end up happening is the good ones will start acquiring the bad ones, because that'll be a cheaper way to buy Bitcoin on their balance sheet than to raise money and do it themselves. Like we saw Strive with Semler Scientific yesterday or the day before.
So may I jump in?
Of course, Josh.
So I am not advocating that we mix Bitcoin with other types of assets.
Good, you can stay.
I would leave that aside. What I would say though is, I'm not necessarily even saying that we should have digital asset treasuries with a whole bunch of different types of tokens. I'm not saying that. What I do think, and I'm seeing it in deals that I'm helping to put together now, is this idea of having some kind of strategy that is different from just saying, I'm going to buy more, I'm going to buy more, I'm going to time the market, right? To try and say what complementary kinds of businesses, whether it's the idea of a consumer DAT, right? Or you could have a gaming DAT, you could have something else where there is a specific token involved, but then you also have some kind of operating company or operating companies, and I think we're going to see a bunch of roll-ups as well.
Yeah.
Because I think they're
I'm sorry.
yeah, just one last thing is, I think there's a lot of money that wants to come in, but they're afraid to come into the DATs for exactly this reason, and that's why they're trying to create things that can kind of cross-pollinate and feed themselves. Sorry.
Yeah. No, unfortunately, I think we're up till now, as you said, I mean, a lot of this has been equity financed. I mean, some of the original strategy or MicroStrategy deals were debt financed, but they very quickly got all that debt off their book. But what I'm really concerned about is we're going to see not just sort of like operating model or operating business sort of diversification, but we're going to start to see a lot of balance sheet innovation in the form of leverage, and it's just a matter of time, because there are no restrictions on the ability of any of these companies to lever up, and or at least in the United States. And typically in the United States, we would typically have thought before Mike Saylor created a treasury company, we would have thought that would have been a 40 Act product, basically, a regulated investment company act product. Which prohibits leverage or has really strict limitations on leverage, and leverage very, very broadly defined. But people would think about doing these sorts of plays in the form of either 40 Act companies or companies that were set up as trusts that really didn't have a lot of ability to do funky things, whether that's staking or levering. So Mike Saylor had the idea to do this in a C Corp, and in the United States, that means that you have taxation at two different levels. The corporation itself is taxed, and then the shareholders are taxed as well. And so it was thought of as a very inefficient way to sort of engage in this kind of activity. But MicroStrategy and now all these others have proven that you don't have to. So they've ended up in very lightly regulated companies, and it's only a matter of time. We're hearing about it already. It's only a matter of time before these things just put on so much leverage that just a tiny little blip in the market can cause the entire house of cards crashing down. I hate to sound like a wet blanket, but I'm very concerned about what's going to happen. And in the United States, at any rate, what always happens following any kind of crash, any kind of a market correction, is suddenly Congress comes in and the regulators start clamping down. And I really don't want us to have to go through another crypto winter like we did when SBF was sort of found out, all the way to the election of Donald Trump. And that is my fear right now. I mean, I feel like we now have an opportunity to actually begin to explore like real use cases for digital assets and to make digital assets part of, you know, a more accepted part of both finance and, you know, sort of commercial applications. And I'm so concerned that the digital asset treasury phenomenon, you know, poses a real sort of risk for us.
Yeah, I mean, I agree. And I think one of the things that when we had a little prep session before, Joe, I think, I don't want to misquote you, but I believe you were bringing up some things about, you know, digital asset treasuries trying to differentiate themselves by investing in other digital asset treasuries, right? And how that could begin
Some would call that a pyramid scheme.
Yes, exactly, exactly. And it also harkens back not just to, you know, to 2007, but also 2021. Right, and 2022 when we had rehypothecation and too much, you know, contagion. Nevertheless, just to stay on a more positive note, I mean, this is bringing energy.
Rehypothecation. Tell me what that means.
So if you're like pledging and then repledging the same asset, so essentially, you know, there's an asset and I loan it. Mm-hmm. And then you loan it on. Exactly. And then but in the end, it's just one asset, and you know, we're all kind of
repackaging.
Exactly.
Yeah. As I remember in my audit days, looking at a credit insurer, and they had all these kind of different debt obligations, and they were all rubbish. And then they all had like junk rating, and then they all got put together. And my manager said to me, and then when they put them together, then they get an A rating.
Yeah.
And I said, well, how does that work? He goes, just audit. He goes, just check the things. And I was like, and that was the last thought I had. And then,
but that's what caused the financial crisis 15 years ago.
Well, quite. That's kind of why I thought.
The one just quickly on the treasury companies that invest in treasury companies also causes another issue of how on earth do you value that? Because so Nakamoto, let's talk about Nakamoto. They just launched recently. The guy who launched it was David Bailey. He's the CEO and founder of Bitcoin Inc., Bitcoin Magazine, Bitcoin Conference. It's the biggest Bitcoin media company in the world. They just raised 710 million within like a 3-week period to then go and do their own Bitcoin treasury company. They've got some investors, some unbelievable investors got into this. And their thesis is to buy, they bought like 600 odd million of Bitcoin, but then they're going to buy Bitcoin treasury companies that they're already investors in. So how do you then value that? Because if you're comparing that versus, say, MicroStrategy, or, you know, in this country, Smarter Web, or, you know, BHODL, who just listed, usually you would compare them by saying, how quickly do they cover the premium you pay, and what is the value of the Bitcoin versus the market cap? If you then throw in another mix of how do you value the MNAV of an MNAV, then how can you possibly value that? So I think ones that do that are going to take quite a long time for the market to be able to get their head around it and value it. Because a lot of people in the UK, I've been banging on to wealth managers and investment managers for years of when are you going to buy Bitcoin? And their issue is how do we value that? So if you have, the industry can't even value Bitcoin or price fair value on Bitcoin, how in the world are they going to value that?
Sure.
And it's you know, a super hurdle for them to be able to get over.
Yeah. And so I think this discussion has shed some light on one of the questions within this, which is about the maturity of the market. And I see the maturity of the market kind of from two sides. So from the sides of the digital asset world and maybe the products that are being offered, but then also the maturity on the side of the investor. And alongside kind of maturity, you can also kind of pair what I would call risk appetite. And so, and risk appetite is often informed by understanding of what you're doing. So in terms of market maturity from an investor point of view, so these products have really come to market, as I understand it, these treasury companies, to try and meet a demand that was which is otherwise unservable because there were regulatory restrictions, right? And from, we can pontificate and talk about what we think is going to happen, but certainly there's indicators in the market. I think even in the FT yesterday, there was talk about some of these treasury companies trading at a massive discount and being gobbled up by others. Where am I going with this question? In terms of the risk appetite comes from form. So in terms of market entrance, people have been saying them Bitcoin, and Peter, I think, as you quite rightly said, there's that big distinction. And Joe, you've talked about ETH and Sol, but there is that big distinction between, and Bitcoin's the kind of the gateway. But from a maturity point of view, the other stuff, the ETHs and the sols, you know, where has the market got to on that? And I'll give that question to Joe first.
Well, I think you have to first ask, what do you mean by the market? I think there's a retail market and, there's an institutional market.
I mean institutional, yeah.
Yeah, and I mean the retail market, you know, these are the people that are buying GameStop, right? And they're buying meme coins, and you know, God bless them. You know, maybe they can, you know, some people will make money, a lot of people will lose a lot of money. I think the interesting thing is with institutions, because of course, you know, institutions at first did not touch Bitcoin, whether because of, you know, just natural skepticism of the PMs, or you know, a fear of being called out by their, you know, by their
reputational risk.
The reputational risk. You know, the banks. I remember the major banks not allowing Grayscale's the Bitcoin Investment Trust to you know, onto their platforms, and of course a lot of people missed out on a lot of money. And so I think that institutional investors now realize that, you know, some exposure to Bitcoin, maybe not all of crypto, but some exposure to Bitcoin, and you know, you might think of Coinbase or Gemini or Bullish or Grayscale for that matter, which, you know, is sort of in the IPO process right now. You might think of them as proxies for Bitcoin. But I think, you know, most institutional managers now realize that you know, that's an asset that they need some exposure to, in the way they need exposure to, you know, to PE or to real estate or to anything else. But I think, again, once you get away from Bitcoin, and again, I would put Sol and ETH and, you know, maybe some other layer ones in a different category. You know, you then have, you know, what's maybe, I don't know, one of you would probably know this better than me, but like maybe a third to 40% of the market is in these coins that I just don't know what they are. But they're retail only. I don't see institutions moving into those things, and yet we are seeing DATs that are moving in those directions. You know, I think the industry has to prove that there is something more here than just a shell game. You know, the industry has got to prove that there are either commercial applications or financial applications. I mean, everybody knows that Figure went public a week or two ago. You know, Figure is pioneering P2P lending and things like that. The industry has got to prove that there are actual use cases for these assets, as opposed to just a store of value in the case of Bitcoin, and maybe, you know, a way to have a smart contract network in the case of ETH and Sol. And unless this is now their shot, this is now their do or die moment, and unless they're able to do that, I just don't see a long-term institutional thesis for most of the thousands and thousands of tokens that are out there right now. And I'm just a lawyer. What do I know? But that would be the way I look at it.
I'd absolutely agree. Unless there's regulatory clarity and a very, very clear use case, it'll just die. So if you look at Bitcoin, has a very clear use case. There's so much money printing going on in the world. There's every currency. If you look at the dollar's depreciated 95% since 1971. How can we carry on? If I was to offer you an investment that you're definitely going to lose money on, would you take it? Absolutely not. But we all hold pounds, dollars, euros. It's all going down the toilet because they're printing so much of it to get themselves out of their own financial problems. So the more that happens, so that a lot of the people in the Bitcoin world say, where fiat's got no bottom, Bitcoin's got no top, because it's going to be an immediate response to, you know, if your purchasing power is permanently eroded through no fault of your own, you're not going to carry on using that currency. So that's why Bitcoin's future is brilliant for me, in my opinion.
Saylor says 30 million. I don't know how he came up with that number, but
I think it's because he wants it to get to it, probably because he's got the most. I just think if Bitcoin, if pounds carry on, so I think the dollar's just in 5 years lost 20% of its purchasing power. So how can people live with that long term? And that's where the wealth divide happens. And one of the other issues you've got is fund managers at the minute need to do something because they can't outperform the market. So asset prices are going up, house prices are going up, all because they're just pumping more dollars or pounds or euros into the system. So of course asset prices are going up. So you could have a fund manager that can't outperform the market because everything's going in the same direction. So that's why these digital asset treasury companies, they're like a release valve for an investor who can't do anything. You might as well just buy the Mag 7.
So I think you're laying out the classic, maybe Satoshi argument for Bitcoin, something that there's only 21 million. But I do think you then have to answer, well, how come Bitcoin sometimes seems correlated to these other asset classes?
It's regime. So it will always seem correlated because markets move in similar ways, right? So if everybody, for want of a better word, shits themselves, they're going to sell everything. And the reason Bitcoin goes first is, let's say, I don't know, something bad happens on a Sunday afternoon, or Trump tweets something on a Sunday afternoon. What else are you going to sell on a Sunday afternoon? You can't. So you have to sell Bitcoin or crypto. That's the only thing available. So Bitcoin being open 24 hours a day, 365 days a week is almost one of the problems, and what reasons it is volatile is because if I'm in China, the first thing I can sell if something goes wrong on a whatever day it is, if the market's closed, I can't sell anything other than crypto. So that's why that tanks hard, fast. And if you look at the weekends are notoriously volatile because the market's shut. No one else can sell anything else.
So my guess is that Paul Atkins would love to see 24/7, 365 trading for all asset classes.
Well, that would be an absolute free market then, wouldn't it? Then
so
a free market would actually exist.
If that happens, you think that the correlation maybe would
yeah.
Okay.
And I think it's so cyclical. And Bitcoin is viewed as a volatile asset. So as soon as there is any bad news, that's the first thing that goes. And I think that's eventually will start to drop a little bit as Bitcoin becomes more adopted. It will become less volatile.
Very interesting.
So it'll be one of the things that changes. The other thing I think that will change is the more people are educated in Bitcoin, the less volatile it will be. Because when there was, I think there was a flash crash in February, and Glassnode did a load of data, and the only wallets that sold any Bitcoin were wallets that were less than a year old. Nobody sold. So everyone a year over was, if you've been through Bitcoin cycles, you're happy to sit in a burning down house. If you're new to that, you're running for the hills. So that's the difference between long-term investors. And the more long-term investors Bitcoin gets, the less volatile it will be because everyone will be used to the burning down house. They'll just wait for the fire to stop and someone to rebuild the house around them.
So how do you think about, just going back to one of the reasons why the SEC for so long, tried to keep people out of it. How do you think about exchanges operating in the Far East, places where there's a lot of concern about wash trading and match trading and everything? How do you think that that's as big of a factor in the price setting mechanism as certainly the SEC was concerned about that?
Well, I think given it's one of the only things that's a fully decentralized, not actually run by any particular country or market, that will definitely, you'll have to contend with, whatever market you're in, you'll have to contend with problems that are in other markets around the world because it can access the same thing at the same time. And I think once Bitcoin and crypto almost needs like a globally agreed regulatory framework, which is very difficult to happen. Even in Europe, we've got like 30 regulators saying 30 different things. So to get everyone in the world at the same time to say the same thing is nigh impossible. So I think every regulator is going to have valid reasons to be concerned about stuff that will happen somewhere else in the world that can affect the price and the validity and the manipulation of Bitcoin and crypto.
Josh?
So, I agree with a lot of what has been said. I do think, though, that while in the digital asset space, it may be winner take most, right? And that there will be a culling of certain tokens and blockchains. I mean, I don't think it's just like, I realize we have probably, at least on the stage, some Bitcoin maxis, right? At least
maybe one.
Yeah. While I think Bitcoin is perhaps, some have said for a long time, maybe Bitcoin is the killer app of blockchain, right? I don't think it's the only. And so I do think that beyond ETH and Sol and Bitcoin, I think we're going to continue to see innovation. I think that's why many of us got into this space. Obviously, it's quite a tribal space many times, but I think there's going to be promise. I do have some questions myself about some of the DATs dealing with, as Joe noted, shit coins, right? I think that's a challenge. I think what's interesting, though, is the meme coins, as Ron and our friend David Brill, who isn't here, have often pointed out to me, that certain of the meme coins are highly correlated with Bitcoin, which is very strange. But
for now.
Yeah, well, for now. But I also think, when you think about the large holders, even of Bitcoin, right? Yes, as more and more institutions get involved and there's a stability so that perhaps, yes, it's less likely to be as volatile over time. I do think also people are, if they ever want to sell and they are a large holder, who is their counterparty and what happens to the market? And I think that is
liquidity.
Yes, that's a challenge generally. And when I've heard from certain, this is not investment advice, this is not a prediction, and it's not legal advice either. I guess I'm not sure if we can give that disclaimer. But when I've talked to some folks in the industry who are very, very large holders of Bitcoin, like very, very, very early in the space, some of them have predicted that we're going to see a dip, right? In the first quarter or something like that of next year. Well, what does that mean? If they have this much Bitcoin, what does that mean? Does that mean they're going to profit take? Like, what is happening behind the scenes when someone says something like that? And we know that it is cyclical, but I do think that just a challenge in general is the liquidity piece and how people making money if they can't actually realize it.
Yeah, I echo that actually, because the more these Bitcoin treasury companies buy up a load of Bitcoin and they say we're never going to sell the Bitcoin, what happens when they've got all the Bitcoin?
Yeah.
What if I want to buy some Bitcoin? Where do I get it from? So does that create a supply shock and the price goes up, or does it just collapse the market because it's not available? And just on your shitcoin point, I'm firmly a believer in Bitcoin. I firmly believe that there'll be other cryptocurrencies that do some great things over the next 10 years, but I don't think you could sit here right now and say this is the one that's going to be it. But I can say Bitcoin's going to be a store of value that will rival gold.
Very good. So I'm just looking at the clock. We've got about 8 minutes. I just want to gauge from the audience, how many questions are out there? Very good. Any more? 2? Okay, so I think I'm going to do have you got a question? Yeah, okay. So I think we're going to do a quick wrap-up, and then we're going to go to the floor, because that will give us time to kind of answer those questions properly. So the final wrap-up, I mean, I think we've kind of possibly touched on it, but, and it's a nice question at the end of these things, is, kind of what next? Like, where's, beyond, we've talked a lot about Bitcoin, but in terms of maybe, we talked about the possible fate, or certainly the evolution of these treasury companies, but either from a regulatory point of view, from a territorial point of view, from an investor appetite point of view, what do you see as the kind of next evolution?
I think I've got a question for the audience. Put your hand up if you either own Bitcoin or a Bitcoin treasury company. Yeah, so look at that. Hardly anybody in a room where there's a crypto event. So that's what needs to change. People need to understand it, learn about it, start actually adopting it, because there's no point people working on the rules around it that don't actually own it and believe in it and have it. So I think education is a huge thing, and I think financial education in this country, and probably globally, is nowhere near where it should be. So there's not many things 100% of adults have to do, and financial planning in some way, shape or form is one of those things. Why is that not on a curriculum? And once that becomes on a curriculum, you'll have people that are more aware, they'll start to be engaged to learn about financial planning, and one of those things will be invested in cryptocurrencies, especially for the young guys today. That's all they seem to care about. So the next thing that needs to happen is education, and people like this come into a conference, understand it enough to think, actually, that's a good investment.
Well, because I'm going to give Josh and Joe, but just to add to that, at an investment association event I was at, it's definitely true from a point of view of like demographics. In the asset management world, what I hear from them in terms of getting talent into the asset management world, they go out to the schools, they go out to the universities, they want to talk about the asset management industry. All these guys want to talk about is digital assets, Bitcoin and the rest. And so there is that kind of, there is going to be that, just through the passage of time, that growing demand for people to be able to provide products and services to a consumer who's going to demand it.
There'll be a huge generational shift as the baby boomers start to die. There's something like $1 trillion of wealth that will pass by like 2035, and that's going to come down the age groups, and the younger age groups are buying Bitcoin and crypto. So if any asset manager wants to keep up, there's going to be a huge amount of money that's going to pass from one generation to another, and that's going to need a home.
Josh.
So where to go from here? I think maybe I'll try and put some positive spins on things, because we've been a little bit dark, right?
We like
said
positive.
All the dark
we
things.
like positive.
So I will say, a lot of people have compared now to like the ICO boom in 2016, 2017, right? I guess part of 2018. And while people may have lots of feelings about the ICO boom and what came out of that, it did generate a lot of excitement for the industry, a lot of interest. I think we're seeing people come into the industry who previously hadn't. We're seeing more and more financial institutions and other institutions, as well as consumers, get involved. The administration in the US, I've been saying the US is finally open for business. Now, one may say, has it gone too far? In some respects, perhaps. But I do think in terms of what will help also get people into digital assets more generally, apart from education, which is so important, is gaming, right? I think one of the things, and these consumer applications where people don't know that they're initially dealing with digital assets. So for example, if you are playing a Web3 game and you get a wallet, right? By playing this game. You might not do anything with the wallet right now, but you have one. And whether you know you're into crypto or not, when you're getting this or you're getting that within the game, you are becoming part of the digital asset space. So I think things like that and consumer applications where people are not aware, I think that's also going to be a big growth.
And that's kind of user experience, exactly. So more broadly, the user experience, instead of having to, because I try and work with these wallets, and I end up constantly in a muddle.
Buy an ETF.
Well, I've just got this. I've got coins on a wallet on a different blockchain. I can't switch it, and then I lose my key, and I do all the things that we talk about in the course not to do. But it's just like it's not a great user experience still, in my opinion. Yeah, I think that's definitely a blocker. I agree, and gaming's a big one. So, Joe.
Well, in terms of what's next, I think there's probably retail demand in the U.S. for a mutual fund type product, like an actively managed fund, as opposed to the ETPs, which are either single asset or follow indexes. And there are regulatory reasons in the U.S. why that is not a possibility today. But I think if an asset manager were to come up with a well thought out plan and go to the SEC, they may be able to get regulatory relief. And I for one, would invest in an actively managed fund if I trusted the manager.
I'll introduce you to one. Okay, let's go to questions. Yes, we take the first one. And then we'll go to your question.
Hi, my name's Emma Channing. I'm a partner at Spencer Phone. I'd be curious to hear from the panelists what you think would qualify a CEO for a DATCO. What are the things that you think are critical?
Somebody with a very strong financial services background. Not necessarily somebody who's just a dyed-in-the-wool true believer in the asset class. I've got friends who are the ones that are getting calls from 5 different companies a day, and I would want somebody with a really deep financial services industry experience.
Thank you. Over here, we got a question.
Hi, I'm Tara. I head up a product for an institutional staking firm. There's been some talk about the yield generating aspect of ETPs and digital asset treasuries. Obviously with ETPs, they're pretty limited with what they can do, especially from a staking perspective because of cooldown periods and their redemptions. Digital asset treasuries don't have those kind of restrictions. So they're already looking at pretty creative stuff. They're looping on Aave, etc. That could create quite the gulf between the returns that institutions can get on the ETP side of things versus the digital asset treasuries. So do you expect that there might be a softening of positions on ETPs, starting to do more sophisticated yield gen, maybe looking at different redemption timelines for digital asset ETPs? Or do you think that digital asset treasuries might start being curtailed in some of those activities?
I mean, we're actually looking at yield products for ourselves, actually. And if you're going to try and create a Bitcoin yield product, You need to do it in a way where a regulator's going to understand it and allow you to then say, okay, I see what you're doing here. So there's quite a few Bitcoin staking is becoming a thing, and I don't think a regulator would go anywhere near that until it's had a few years track record. But there's millions of ways traditional markets create yield on, securities lending or just taking options or derivatives on it. So that will be what starts to happen first, I believe, because regulators will be able to understand it. They'll say, okay, well, we see you doing this with other asset classes. This product just so happens to be Bitcoin. And I think there's sometimes a bit of a scariness around Bitcoin. It's just another asset, right? So if we've got an exchange-traded fund, it's just structured like, I know, we have an S&P 500 fund. It just so happens to be Bitcoin. So once regulators get their head around, we've already established we accept the asset. If you then start to do traditional things with that asset, that's not out of the ordinary. So that's how I believe we'll be able to move forward with creating yield on crypto products.
Well, I would just say from the U.S. perspective, the hurdle to staking inside of an ETP is not really the SEC, it's the IRS. And here's a prediction. I predict within 6 weeks that will not be an issue.
I agree.
I agree.
Good, let's finish on agreement. That's a wrap. Peter, Josh, Joe, thank you for the questions. Thank you, everybody.
Thank you very much.
Thanks very much.
Thank you.